seeing a cut of, around 230 points. So over 1% gone on the Hong Kong markets as well.
Number itself, 13.5%, is below market expectation. Our poll was 15%.
They are very clear on the fact that this 13.5% is very much consistent with the overall growth estimation of around 7 to 7.5%.
The first impulse should be to buy the dip. Whether that works out or not, the risk-reward trade would be that.
I don't think tightening in the US will have an impact on our economy directly. Indirectly, there might be some impact in terms of stock markets and valuations.
They've signed a licensing agreement with Star to air on linear television all the ICC events between 2024 and 2027.
The Nifty is down about 248 points.
This is a good market which gives you a chance to get in when you want to get in. It gives you a good chance to hold off and sit on the sidelines when you need to.
There's also an uncertainty due to certain pronouncements by the government of India, the government of Nigeria restricting the movement of motorcycles.
It's a 7.3% year-on-year growth that Escorts has reported.
Fourth fortnightly review of windfall gains tax levy. Government has hiked the levy on domestically produced crude oil to 1,300 and 300 rupees per ton.
For now, it's around a 1% cut that we are seeing on the Nifty.
Good afternoon and welcome to Closing Bell. I'm Anuj, with me Prashant and Reema joining us on the show today. And well, we've had a crazy day in the market today. The market had a gap down, 250-point gap down. The market recovered most of it. On the Bank Nifty, actually it went into the green. And then, for some reason, fresh decline, which took us back to the morning lows. So, a very interesting kind of market. Of course, as I said, the Bank Nifty is outperforming, though that's also given up a lot of the gains. But still outperforming. The broader market has been quite resilient. In fact, advance decline has been through the day in favor of the advances, even as we speak, marginally, but still in favor of the advances. And the Nifty, as of now, is holding out the 20-day exponential moving average, which is placed at 17,425. In fact, even that second decline has sort of showing signs of getting bought once again. So let's see. Very interesting last hour lined up for us. Prashant, Reema, good afternoon.
Hi.
Hi, afternoon, guys. I mean, at any point you can look at the market and you'll say, wow, right? Yeah. Because there are so many twists and turns to this. And, it's impossible to say whether the market is hugely up or hugely down. It's that kind of a screen. So the graphic will tell the story. We got a gap down of 291 points. This is, the initial sort of straight gap down that we got. Then we got a bounce straight up to about, which was about 210 odd points. So all of this happened, by the way, this 291 point gap down and then 210 point bounce in the first 1.5 hours of trade. After that, it's just been sideways, slowly grinding lower. And post the bounce, we are down 200 points once again. So, net of all of this, where does it leave us? It leaves us lower by about 250 points as compared to last Tuesday's close, the last trading session. So, extremely big swings, wild swings. I'm not even mentioning the 30, 40 odd point moves which come and disappear just like that. So we'll just have to wait out till 3:30 to find out the final numbers. It'll also be interesting to see the flows picture, right? The last provisional data we have for Tuesday in terms of what FIIs did on Tuesday was a large buy figure, 4,000 crores. So after that kind of a number, will it at least be positive in terms of just a follow on? And not anything large negative. I think that's something else which bears watching as well. Reema, hi.
Hi, afternoon. And by the way, the Dow Futures is down 200 points. So after a 4-day correction that we've seen in Wall Street, it appears that Wall Street could start lower even today. So the Dow Futures, if you could get that played up for you, is currently down about 200 points. Did any of you guys read the letter by Jeremy Grantham of GMO, where he said the super bubble is yet to pop?
I read the first para basically. By the way, Grantham is a fellow you'd want to listen to.
He's got so many cycles right.
Yeah, long-term investor in emerging markets. And I remember very clearly when we were in the depths of the COVID crisis, the crash that happened, he was one of the first to come out and say, well, this is excessive and things should start to bounce. This was, I remember middle of March, 20th of March 2020 or something. So
he wrote
it was a short one-pager. And
So he wrote another letter yesterday and he said that the collapse of a super bubble takes place in various stages. First, there is a setback, like what we had at the start of the year. Then there is a rally, which fits in with the summer rally over the last 2 months. Then the fundamentals break down, and then the market reaches a new low. So according to him, the worst is still to come. The super bubble, as he calls it, is yet to pop. So we're going to be... You wanted to say something?
No. The issue is how to sort of action that, because in India, what people want to understand is that do you buy in the morning or do you sell in the morning, and do you cover it in the afternoon or not? So that is the point. By the way, on bubble, by all respect to everyone, my theory in bubble is an asset class in which it's rallying and you're not long. So everyone has their own theories of what asset is in bubble. I remember for long people kept saying Bitcoin was a bubble, right? When it went from 100 to 3,000, it went to 60,000. So at the end of the day, maximum money is made in the bubble. It's just that you need to know when to get out.
Mm-hmm. Yeah, no, absolutely. That's well put. What we'll do is we will tell you what's happened and what's lined up here on the show over the next 1 hour or so, and then we'll bring in guests. So auto sales numbers for the month of August are trickling in. We'll get you the latest updates with Sonia. SpiceJet is under pressure after the company reported steep losses in its financial statements. A complete analysis coming up. And finally, we discuss the way ahead for the markets. N. Jaykumar, Managing Director of Prime Securities, joins in for that as well.
Okay, but as always, we start the show with last hour calls, as we normally do with Mitesh Thakkar. Mitesh, hi, good afternoon. The morning dip was bought, and then we had that second dip, and that's also getting bought now, Mitesh. Your thoughts and your stock calls for last hour?
Actually, today's action has been very confusing. I think the idea was to buy on the morning dip. That worked well. Then we got sold on. We kind of nearly retested the low, and then we're trying to bounce back again. So the only thing which it is confirming is that 17,420, 17,430, the 21-day, the 20-day exponential moving average area, I think that kind of, comes into play strongly. And unless that is being wild, or the Nifty starts closing below that, I think don't go aggressively short. So you would want to be, trading with more stock-specific biases, but I think slightly more bias on the positive side and exploring more long ideas. We have been trading long throughout the day, though right now I have one buy and one sell call. The buy is on Intellect Design and Software. I think a very strong price and volume action taking place over here. So that's a buy with the stop below levels of 594 and a target of 630 on the upside can be looked at. And National Aluminum Nalco is just mildly on the verge of breaking down. So if it breaks just below today's low, which is about 77.25, so keep a trigger of 77, sell below 77, the stop at 78.5 for targets of 74.
Okay, that is the trading idea for the last 1 hour. Gurmeet Chadha, the managing partner and CIO of Complete Circle, is also with us on the show now. Gurmeet, afternoon. What have you made of the wild swings that we've seen in the market? How would you characterize the market right now?
I think now guests getting pretty used to it, these wild changes in the market. And also I think there's a very interesting report which has come in on, this unbundling of emerging markets, right? So, which is by Erigo, and it's quite an interesting read and makes some sense. I think if you see the performance of India in terms of our GDP growth, in terms of our credit growth, the fiscal numbers came out, the tax collections, I think some bit of that positivity is reflecting. I'm not saying we'll be completely decoupled. There will be collateral damage as both rates go up and quantitative tightening happens. Also, I also think that the inflation through aggressive rate hikes in a supply disruption scenario, though I'm not an economist, is not something which you can persist with for longer in terms of slowing growth. So I think some unbundling is happening. Some more will happen as things gradually improve. I was seeing the MSCI EM returns, emerging market returns, for last 10 years is flat. Last 3 years again is flat. But MSCI India last 3 years is 13-14%. 5 years is still 8%. So I think this unbundling will continue to happen as China slows down, as Latin America becomes more populist. And there are some concerns. We saw that in August flows also. You saw India getting 75% of the ex-China flows in Asia EM. So I think this unbundling would play out. And I think the best thing to do in a market like this is that you buy where there is visible growth both in top line and earnings. That remains your perfect hedge. Equities, by the way, if reasonably bought and has good earning growth, is the best hedge for inflation.
Okay, the market, by the way, is seeing another sort of recovery from the lows from 2 o'clock when it looked like the market was testing. In fact, on the Nifty, we almost went below the first hour low, but we are again bouncing back on the bank Nifty as well. But today's weekly options expiry, so things can be really all over the place. Just keep that at the back of your mind. Gurmeet, hi, good afternoon. Thanks for joining us. Wanted your thoughts on what's happening with the Bajaj twins, Finserv and Finance, just relentless buying. Your thoughts?
Anuj, it's one stock which I keep saying is a consumption stock, in the NBFC basket. Always a high beta name, and it made 7,700 before clawing back to 7,000. So it remains that. I think Bajaj Finance, if you see till the time they can maintain that 30% growth in AUM, till the time you can maintain 11% kind of names. Mind you, there are 28 different credit lines. On which they work on. After the RBL thing, they're again back on the card business. So I think there are consumption growth levers it has, which is reflected in discretionary spending in the economy. To me, it remains a buy or dip stocks. Maybe at this price, it's a touch expensive. But both the Bajaj twin, and there are probably relatively better options in some of the housing finance names like HDFC Limited. Even somebody like a Chola, where vehicle financing makes a large part of the chunk, and we are seeing some uptick in disbursals and credit quality being maintained. And maybe some banks which are tier 2, which are now probably looking as if the worst of the asset quality and credit cost is behind them, something like an IDFC First, etc. So maybe relatively the risk reward is better there, but remains a portfolio stock for me for long term.
Stay on, Gurmeet. Let's take stock of the auto sales numbers for the month of August. They've been trickling in. Sonia is here with the latest. Sonia?
So it's a mixed bag this time around for the auto sector. Let me start with Bajaj Auto, where the overall numbers looked fine. It was an 8% growth that Bajaj Auto saw. But the real problem was in the export segment, where there's a fall of almost about 28% coming in the export market because of what's happened in Nigeria. Nigeria has restricted the movement of two-wheelers in the country, and because of that, the retails in Nigeria have fallen by 25 to 30%, and that hit the export numbers. The domestic numbers were actually quite good. It was a 49% growth, and the company Bajaj Auto said that they expect this to improve going forward. Apart from that, there was Escorts, which reported a very good set of numbers. The stock is at a fresh 52-week high. The overall August sales went up 7.3%. Domestic sales were up almost 8%, while exports went up 3.9%. And the company said that they expect a better September compared to what they saw in August. Moving on to Ashok Leyland, very good set of numbers coming in. Strong growth across segments. Total sales up 51% year-on-year at 14,121 units, while the MHCV sales went up almost about 81% on a year-on-year basis. Eicher Motors didn't do that well in the commercial vehicle segment compared to its peers. It was barely a 4.4% year-on-year growth. And then we come to Maruti finally, where the sales were below what the street was expecting. So Maruti saw total sales at 1.65 lakhs, which is a 27% year-on-year growth because of a low base last year. But it's below the 1.73 lakh units that Nomura was expecting. Domestic sales went up 30% and exports were up just about 4.2%. So the big trend this time is that the domestic sales have improved substantially while exports have continued to see a slowdown. Back to you.
Yeah, I mean, absolutely. Exports are a pain point. Sonia, thank you very much for that. Markets down 200. Advanced decline is exactly 1:1. So 1,130 stocks are higher and about 1,100 stocks are lower as well. Gurmeet, afternoon, the entire auto space, as Sonia outlined, anything catches your eye?
I think M&M continues to shine. Prashant, been making that point now for some time in our discussions. I think see what is selling more. I think that is the most commonsensical thing to do in auto. I think the numbers were ahead again. This made a new high, almost above 1,300 today in a market which has been pretty volatile. I've been tracking the production numbers closely. I have a client actually who's one of the largest dealer for M&M in Uttarakhand. And he gave me an update that in Dehradun alone they did 100 units in a month and they sold out. There are no bookings they can take even for Navratras. Their production capacity will be augmented from 26,000 units of SUVs a month by another couple of thousand, and then you add 5,000 on the new Scorpio. And the numbers are showing, even in tractors, if you see the monthly numbers with the breakup, I think it's a slight jump there. So that's one segment which has been underperforming. And in that segment, in their tractor piece, now their market share is almost 43%. Last quarter, their margins also were, around that 11-12% rate. I think it's the auto margin which I will track closely, which is currently around 6%. And once this promotional pricing period ends for this new launches, I think with the fall in commodity prices, that will also start reflecting there. And still trades at about 16, 17 times, FY24 earnings. So still, apparently, despite that run-up, looks reasonable.
By the way, it's not just today. This whole week, we've seen some big moves. Monday was a big down day. The Nifty lost about 200 points, 250 points actually. On Tuesday, we recovered 450 points, and today we've lost another 200 points. And net, week to date, we're actually 0.0% move, at least in terms of the benchmark indices. So I think we've just got to get used to great volatility in the market. Gurmeet, another big mover has been Z Entertainment. The stock is struggling. We had good news in the form of the tie-up with Disney, and then we had the negative news about the CCI overhang and whether the timeline of the Z-Sony merger now gets pushed forward, or will there be some dilution in the deal? Your thoughts on Z, and what did you make of the news flow?
This is one stock which, despite good promise, continues. Something keeps going wrong, at different price points. Remember, it used to be 600 levels, before these problems came in of the debt issues. I think we should wait for the merger to play out. I think with CCI raising concerns, I think the timeline Street was working was I think around September, which I think will get pushed now. The combined entity is a formidable entity, with 26-27% market share, complement each other well, both in terms of sports content, regional content, movies, as well as the national channels, even on OTT. Plus, Sony has the capital it needs to, in this, it's quite a capital intensive industry where you need to invest very, very aggressively. I would tend to avoid for now, wait for more clarity. Continues to be a value in the value zone for long, but it's just that something keeps just, cropping up every now and then.
Okay, Gurmeet, stay on. We have more questions for you. The mid-cap index is back in the green once again, though. So it's just very sort of strong broader market. Just look at Tata Consumer's intraday chart. That's been a very strong stock today. In fact, the top Nifty gainer now 3% higher on that, and had a bit of a dip, but once again that's been bought. So looking quite strong over there. We'll take a break. Up next, we'll discuss the way forward for market with N. Kumar, Managing Director of Prime Securities, on the other side of this break.
$17,550 on the Nifty as we speak. This is a firmly down day for our markets despite the big swings that we're seeing on an intraday basis. In the last 30 minutes, there has been a recovery, but the fall is mirroring the risk-off that we're seeing across the Asian markets. Asia closed with cuts of 1.5% to 2%, and Europe too right now is trading with cuts in excess of 1.5%. And the Dow is suggesting that the start this morning for the US markets could be lower by 200 points, making it the fifth consecutive session of weakness. Weak, China PMI data, as well as, fresh COVID lockdowns in China, the weak Q1 GDP print in India, all that is weighing on the market sentiment. Gurmeet Chadha is still with us on the show. Gurmeet, the pocket of weakness today have been the aluminium names, Hindalco as well as Nalco. Any news?
Haven't tracked Rima, but obviously, any news of hike in rates aggressively, slowdown, PMI activity doesn't spell, commodities, I think is cyclical, biggest proxy for growth. So that's why I always say that I find this a little confusing. With one hand we say inflation will remain sticky, one hand we say that there will be, recession and low time. Both things obviously can't coexist. So I would tend to avoid, maybe at a better price point, it has to be a more cyclical call. Hindalco still remains a preferred play. Even Novelis numbers have been very good. The recycle print has improved. They have done some good deleveraging. Remains one of the best integrated players in non-ferrous names. So that remains even Tata Steel, because a lot of the balance sheets are fully deleveraged now. So if you get them at better prices, you got to have a tactical view on it. You can't really. The entire commodity cycle has just played out in 12-18 months. So not for the fundamental investors.
Gurmeet, thanks a lot for joining us and have a good evening. That's the word from Gurmeet. Let's invite our next guest. The market is still volatile. It's down but not out. N. Jayakumar is Managing Director of Prime Securities. He's joining us now. Jakes, hi, good afternoon. Thanks a lot for joining us. Jakes, the kind of moves that we're seeing takes me back to the 2003-04 as well. At that time also we'd seen, when the market was starting that big rally, some of the similar moves, and then there were talks about whether there's going to be some kind of decoupling or not. But you tell us that there's a bit of a debate out here whether we still have a bear market rally or is this a fresh sort of bull market. Of course, Indian context is slightly different, but your views.
Obviously, a lot of this, in hindsight becomes a little more clear. But the way I see this is that, so I call this the Chakravyuh moment in Indian capital markets. You go back to Abhimanyu and in the Mahabharata, the fight that he was having made him get into a formation called the Chakravyuh, and he couldn't get out of it. So the famous thing is, despite being as wonderfully blessed as he was in warfare, but because this last bit hadn't been sort of picked up by him when he was in his mother's womb, if I remember the story right, he couldn't come out of the Chakravyuh. He could only get into it. I think the comparison with this, while it may sound far-fetched, is exactly this, that for a lot of logically correct reasons, the foreign institutions over a period of time have sold off nearly $40-50 billion over the last 6-8 months or more, maybe 8-9 months, barring this last 1 month. That took our indices down to about 15,000. So essentially, logically, as I said, because everybody had a reason, either there were redemptions or they had to move to actually reduce India exposure, or they had to do it with a view to tactically playing other markets like China. These were the three given reasons why, and of course the taper tantrum, etc., leading to lower liquidity in the system. Given all this, we saw the $50-60 billion, which actually has got absorbed through the length and breadth, from Kanyakumari to Kashmir, if you will, through the SIP mechanism. This has got democratized as institutional holding, as individual holding in India. So institutional holding gave way to individual holding. So the foreigners, in a sense, managed to get an exit for 50-55 billion. But guess what? Now, as the dust is settling and some of them want to come in, the first 5 billion has created a move from 15,000 to 17,500 in the Nifty. So I call it the Chakravyuh moment because they've been able to exit, but re-entry on the same parameters, same terms, I think is going to be next to impossible. So we could be entering a period where the Indian markets, where foreign selling has been absorbed and got democratized in terms of holdings as far as Indian individuals are concerned, retail holding across the length and breadth. So we know, for instance, that so many investors sold, let's say large investors sold 2 crore HDFC or 2 crore Kotak XYZ, but we don't know who the buyers are. And that's got completely splintered and broken and fragmented into multiple household holdings. So I think the next move in the Indian markets will make us significantly more expensive. Already a plus 20% on the Indian markets, minus 20 on the MSCI indicates a certain break of the traditional connection. But I think we could be entering a period where we could get significantly more expensive before the buying frenzy, because as you know, as prices go up, paradoxical to commodities, stock prices and demand for stock actually goes up. So demand follows stock prices rather than the other way around. So I think we are entering a very, very important period where we could be optically more expensive than we are today, make new highs, and yet there'll be a great lust for Indian stocks as foreigners try to return. I think that's the kind of scenario we're entering into right now.
Jaikumar, hi, afternoon. This is largely, so first leg driven by local investors and then foreigners come back. That's basically your thesis here, right? How this plays out?
I think it's a smart early money that is seeing that this play with, let's say, China, etc., hasn't, in a sense, worked out. And therefore, what they're trying to do is to see if they can rebalance their portfolio by coming back here. There are new winners for every rally. So you have, extremely difficult to sort of predict, but more importantly, difficult exposures, very limited exposure stocks that people have had to, which are making new highs. And as money starts coming in, apart from the index stocks, you have this massive movement on the mid and small cap stocks. As basically stock prices go up ultimately as selling disappears. Not so much as a result of buying, but the disappearance of selling. And that's what we are seeing right now. And if you compound that and sort of supplement that with some demand from foreigners, the prices are indicating that on every dip, there is buying that's going on. And the figures and numbers are only indicating exactly that.
You know, this valuation point, Jaikumar, just to press on, I was just looking at trailing 12-month earnings here as compared to, this is based on MSCI indices. The MSCI India is now trading at over 100% premium to MSCI emerging market valuations. Now, at any other point, you would draw straightforward conclusions, say that, well, things are very expensive here. But I do wonder whether, because China is such a large weight of MSCI emerging markets, some 33% is China, and that is done so poorly, then this measure, it's the widest ever. This premium is the widest ever. But is this a useful measure, and to what degree, in your opinion?
As stocks become more expensive, they enter indices, essentially forcing more passive buying to happen. So this is not that same logic which says that simply because something is more expensive, the added weight or the increasing weight of India in the basket also could be leading to more buying. But I have a different take on this. Everybody is able to see that we are logically overvalued, if you know what I mean. I say logically means using empirical metrics based on what we have seen in the past, etc., etc. The reality is everybody is able to see that, and yet markets aren't falling. The reality also is that the exposure that foreigners have had to India has depleted significantly over the last several quarters. So any rebalancing towards this, to even normalize this or move towards a median, essentially means that there's going to be disproportionate buying. So my thesis is that right now, we had a long period, even for instance, markets like Japan in the 80s went to P's that have been not seen. So you could say that if 20 multiple on the index is expensive, 25 is more expensive, but nothing to prevent it from going to 30. All I'm trying to say is that simply because something is expensive doesn't mean that the force of demand at this particular point in time does not overpower that particular metric. So I'm not one to say that we must call a top based on empirical measures, because everybody is able to see the empirical data. Everybody knows that this is not an index that can quote unquote sustain. That's what the traditional logic tells you. Whereas my point here is right now, I'm seeing the shift of money, and just on optical fundamentals of the Indian economy, I think there is a lot more money waiting to happen. And that money that's going to come in is not necessarily looking at metrics like multiples for the moment. Within that, by the way, there are in the index, by the way, there's whether it's FMCG or whether it's MNC pharma, etc., that are trading at substantially higher multiples than the index average. And there are sectors, which is, for instance, the banking system, or for instance, anything to do with infrastructure, which is trading at significantly lower numbers. So a lot of money could come into sectors like, as I said, infra, sectors like banking, which could make, which also feeds into the positive capex cycle that I'm seeing play out. So just by looking at an index multiple, as they say, the average at the end of the day may have no meaning. The individual components have a lot more sense that you can draw from.
Jake's afternoon. This is Rima here. Wanted to get your thoughts in on the macro data that we got. Q1 GDP was a miss. Economists have brought down the FY23 GDP forecast. Does it have implications for the equity markets in terms of corporate profitability? Perhaps the EPS growth estimates for FY23, FY24?
I think if there's anything in the corporate sector that is a big takeaway, is last few years have seen extremely low capex plans, extremely high deleveraging measures, and corporates as a whole, especially the big corporates, have become significantly deleveraged. And other than maybe one or two large groups, which are heavy duty groups in terms of market cap, which have taken the leverage. In fact, as somebody said, that you can almost sort of compare the net increase in the banking system credit to just a few groups having borrowed that much. But as a whole, most corporates have deleveraged. And if you take, some of the index heavyweights, I think the leverage has never been this low. And more importantly, the capex cycle, if it were to come back, will spur earnings. So I think just seeing what has happened, and especially macro indicators, I don't think has too much to say or too much to do. I think the RBI needs to be lauded for the way they've handled, this entire transition, if you will, of taper tantrum. They're still in the midst of it. And if you take the fact that most PSU banks have actually gone past the phase of, the write-offs being taken. Most of them are at PCRs of 85 and 90%, and therefore write-backs is the way forward. Therefore, balance sheets of banks, and especially the big ones, the number 2, number 3, number 4 banks are trading at 0.5, 0.6 their book. And as the book starts getting, accreted into as a result of write-backs, plus their normal regular earnings, and if capex cycle were to even move up a little bit, I think you're talking about stocks that could potentially double and go up to 2.5 times from here over the next 2 years.
Okay, you have been bullish on PSU theme in general, Jakes. Let's talk about a couple of other themes which you have been bullish on. Tata Motors for one. I know you're not too comfortable talking individual stocks, but I brought this up because that's been one of your sort of top bets. But after the recent run that we have seen in some of these auto stocks, do you think it's perhaps played out in entirety?
See, all auto stocks have been pure India plays. Maybe Tata Motors, just not to comment on the stock itself, but is as much, in fact, far more to do with the JLR issues or prospects, if you will, than the Indian thing. So it's not a pure play Indian auto play in that sense. So it's moved a lot less than what some of the others have. And, purely from that perspective, I think, any improvement in JLR could be big there. I think, in fact, it's moved less than the others. And again, in the past, I've talked about it, but the risk of disclosure, I want to make it. The DVR is as good a powerful play to play on the underlying stock as any. And we've discussed the DVR theme in the past, so I don't want to go into specific stocks really. But the auto stocks, I think, have run up a lot. My own personal feeling is that as a sector, I would be a little cautious on the auto space. I think it may have limited upside left unless there are stocks within the space which have sum of parts metrics where there's divestment theme being talked about or the EV theme being spun out, etc., being talked about. Other than that, and other than those specific stocks, the sector as a whole, I think, is reasonably well valued.
Jaikumar, any other pockets where you are seeing a lot of value right now?
I think the media space has been largely ignored for many years now. And I think there's enough and more consolidation that's happened. That's number one. I think even so media space, there are only 2 or 3 really large players there, and all of them are well consolidated. There's pricing power that exists, and my own assessment is that these assets have never been seeing this low level of a multiple that they're seeing currently. And especially if you take the sum of parts in some of these cases, I think they're extremely compelling at these levels. That's as far as the media is concerned. And the other thing is that the well-integrated metal and steel players, now after a long time, you've normalized in terms of the end product prices coming down and the input prices having come off a lot. So the margins are intact. So for well-integrated players who've dramatically deleveraged, those are the 2 caveats. Well-integrated players and those who have dramatically deleveraged or become near zero debt. Those are the kinds of players that could actually as this capex cycle or as the demand cycle picks up, I think could be hugely benefited.
Okay, Jake, so before we let you go, what to your mind is the biggest risk factor for this market? It's been a very strong market. I mean, so much FI selling. If it was a market of 10 years back, this kind of FI selling would have broken the market's back. Market hardly flinched. I mean, we were down 18% from peak to the recent bottom, and the markets moved on. But what to your mind is the biggest risk?
See, before the risk, I think I want to point out this fact that the exposure of the Indian, should I say, working class or the Indian polity to the equity markets was in low single digits. Maybe that's moved up 1% or 2. And the percent or two has been good enough to absorb $50-60 billion of selling quite comfortably. My assessment is the big risk right now, if you will, is a lot of people are probably not realizing that this is a time when the markets may be going through a one-time re-rating as more and more of this SIP-related money walks in. So there is nothing to say. For instance, if you look at the local sell figures, you're not seeing any large domestic selling. Maybe they're cautious buyers, but so the money flow, as long as it continues, you could be sitting on a dramatic moment where you're actually getting re-rated to a higher multiple before this, before the settling down happens. So the risk right now from an individual perspective is if they're not invested enough in the markets. That's number one. From a market as a whole, the risk point of view is there's very little leverage, whether in terms of individual positions of very large players. I don't think there's so much leverage. Number two, there is no leverage amongst the corporates. So what could actually go wrong is if the capex cycle doesn't take off, which in a sense is getting factored in. As people are buying into some of these stories, they're assuming that capex cycles and the capex investments will follow. If that still turns out to be a wolf, a cry of wolf crying for wolf, as it were, then perhaps the earnings will take a lot more time to catch up. So the markets will be more expensive than they look today. But if the sectors that I'm focusing on, which is things like, as I said, financial services and the capex intensive, I think to me that's the risk that I see, that the capex cycle needs to take off at this point in time.
I like how you put it. Maybe we are in the midst of a one-time re-rating. All right. So that's interesting. Jaykumar, thank you very much.
I call it the Chakravyuh moment, and I call it the Chakravyuh moment because I think it draws a lot about preparedness for various things. And I think sometimes people end up becoming more analytical than they need to. Yeah. There is an overall feel-good shift that's happening here. And without actually having to thump my chest or bang the table, I think the point that's being made here is that there is a significant risk that individual investors have of not being invested in the markets.
Oh, yeah. I mean, I think we'll get the July mutual fund numbers soon, and we'll see. I mean, the SIP flows have been pretty strong, as Jaykumar pointed out, but discretionary inflows have completely crashed from its all-time highs. They've come off very, very sharply. But the SIP number is still pretty solid, 9,000, 10,000 crores or so. And that's been the bedrock as far as this retail inflow is concerned. Jaykumar, it's always a pleasure. Great to have you with us here. Thank you very much for your time. We'll take a quick break here. As always, we'll get you a check on what dealing rooms are saying and doing. Nimesh, of course, joins in to tell us that. We also will tell you buy today, sell tomorrow calls from our technical expert. All that coming up in just a bit.
मैडम जी वो सारे पैसे लेके भाग गए और मेरा वड़ा पाव भी ले गए।
दिखाते हैं इनको।
मोटा वड़ा पाव?
डीलर निकाल दे इसके बाद।
पंक्चर के बाद भी इससे हवा नहीं निकलेगी क्योंकि ये है जेके पंक्चर गार्ड टायर जो कील लगने के बाद भी होता है हील। जेके पंक्चर गार्ड टायर, अब हवा नहीं निकलेगी।
LIC
आत्मनिर्भर भारत की गौरवशाली संस्था मना रही है आज अपना स्थापना दिवस। गत 66 वर्षों से मिल रहे आपके प्यार और विश्वास के लिए हम आपका हृदय से करते हैं धन्यवाद। सुरक्षा और वचनबद्धता का ये सफर हमेशा रहेगा बरकरार। LIC, हर पल आपके साथ।
Welcome back. Well, the market, of course, bounced back in the morning from the lows, but the second dip that you are seeing, again, my sense is it could be purely because of what's happening in the currency market. The dollar index in the morning had retreated to 108.4. That's back, and that's dollar rupee, by the way. From the morning highs of, I think, 79.26 or thereabout, it's now in the red and gone to 79.56 thereabout. And if you see the dollar index, I think we're back above 109 on that. It's stubbornly close to its highs, its recent highs, and every retreat, there it is, almost getting back to 109. Maybe that's impacted sentiment on the margin. Let's go across to Nimesh then for D Street Chatter. Nimesh, tell us what have you picked up?
Hi, it's a volatile day of trade, but I guess unlike what we saw on day before yesterday when there was a large buy figure, that's not likely to be the case today. So I understand one of the long only funds is an active seller today. So while the domestic funds are still very active buyers and they are supporting the markets at lower levels, today you might not see a large FI buy figure. In fact, there could be a small sell figure from the larger FIs. That's the overall feedback. But what's driving the larger FI flows? It's basically the ETF money, which is driving across emerging markets, and that's helping Indian markets as well. In fact, from a flow perspective, I also understand a couple of new India-dated ETFs are launched, and hence you're seeing a large amount of ETF money getting invested into the Indian market. So that's a feedback on the overall FI flows. But today maybe you'll see a small sell figure because one of the long only fund is an active seller. In terms of sectors, I guess the two sectors which are well bid today are capital goods and auto stocks. Both the spaces are well bid, and there is a lot of traction now in these two particular sectors for the last many days, and today is the case as well, where there's good amount of buying interest back. Even from a technical point of view, I guess I've been saying this in the past as well. Any decisive move is likely only below 17,200 on the downside, or maybe above 17,800 on the upside. So till the time we are going to be in this range. But today the specific feedback is not large FI buy figure, maybe a small sell figure is what I understand, even though the domestics are active buyers in the large cap names.
Right, Nimish, thank you for that. In terms of specific stocks, what are you hearing? What are you picking up?
So in terms of individual names, the first stock is Krishna Medical. There was a large block deal, almost 2% equity had changed hands, and I believe one of the leading private equity investors who owns a large chunk was a seller in today's block deal. So disclosure will be important as far as Krishna Medical is concerned. That's the first one. Second stock, it's a combination of two stocks, TVS Motors and Indian Hotels. Both are buzzing in trade on good volumes on the back of large buy flows. So largely on buying interest, these two stocks are buzzing in trade today. The third stock is CESC. For the first time, this is coming to my charter list. Surprisingly, there is some interest back in this particular stock. While the stock is not moving today, but I believe this is one stock where there's good amount of buying interest back from the larger FIs. So CESC is the other stock from a delivery point of view to watch out for. And the last stock is APL Apollo Tubes. Again, mid-cap stock buzzing in trade, up 7% last when I checked. Largely, it's buzzing because there was a large seller. A leading FI was an active seller in this particular stock. That seems to be over now. And since the supply is out of the way, a bit of up move in that stock as well. So Apollo Tubes is largely buzzing on the back of selling getting over from a larger FI.
Nimesh, thank you very much for that. Let's re-invite Mitesh Thakkar back on the show. He's going to tell us what you can buy today or sell tomorrow for a reverse trade. Mitesh, what do you have?
Pidilite is, closing a day's high with the gold price and volume action. The setup is quite interesting as well. So it's a buy with a stop below 2,800 for targets of 2,855. And Reliance with the negative news flow, I think, it's slightly ending with a weak kind of a candle. So maybe, you will see some more pressure tomorrow. That's STVT with a stop at 25.76 for targets of around 25.45.
Yeah, Reliance has become very weak today. In fact, that's really also hurt sentiment a bit. Mitesh, thanks a lot for those calls. Ambarish Baliga is now joining us in the last leg of the show. Ambarish, hi, good afternoon. What's the stock pick for the day?
My stock pick today is Heikel. Basically a B2B player that manufactures intermediates and active ingredients for global pharma, animal health, crop protection, and specialty chemical companies. In fact, pharma forms about 58% of the top line and crop protection is about 42% of the top line. But the stock had suffered due to the controversies on disposal of that sodium hydrosulfide. And then the investigation which led to the closure of Taloja unit, which actually contributes about 15% of the top line. So the stock corrected from about 600 levels in January 2022 to about 225 just about 2-3 months back. Currently it's at about 340. So Q1 earnings was a clear washout. Revenues, in fact, declined 17%. Your EBITDA was down about 76% Y-on-Y. And there was finally a loss of 9 crores for the quarter against 50 crores last year. However, we have seen that post the earnings and the management call, the stock, in fact, recovered decently well. And now we have seen Taloja plant is back in full stream. In fact, they used the closure for maintenance, and the key raw material prices also have corrected, so margins should improve going ahead. And what we are seeing is the capex, which was planned, is clearly in progress as far as both pharma and crop protection is concerned. Margin improvement should be seen because of cost rationalization and efficiency improvement measures. So management, in fact, has guided towards a flat FY23, but a high teen growth in FY24. So in fact, looking at an EPS of about 15 rupees for FY24, seeing the stock back at about levels of 450, which is a decent about close to 30% sort of a gain from here.
Okay, that's Heikel for you. Expect the Taloja unit to start contributing, which will result in big moves, big returns for the stock perhaps, and financials next year. Ambarish, afternoon. What about Biocon? There was this news about the US FDA inspection at the Bengaluru as well as the Malaysian unit. Well, the management came on the channel and they seem to suggest that there are no data integrity issues and it should not affect the company's launch pipeline, etc. But your thoughts on Biocon?
No, I also believe that in the slightly longer term, it should not really affect. But whenever there are observations because of US FDA, we normally see a sort of a correction in any pharma stock. But then if you look at Biocon, the way it's been underperforming for the last, I think, 6-8 months or maybe more, that major correction did not happen even because of these observations. So, in fact, I don't see much of a downside. As far as Biocon is concerned, I think 295, 300 seems to be more or less the sort of a bottom sort of a range. I think it's, this sort of news typically in pharma stocks is in fact a buying opportunity. And I would say that's a possible opportunity for Biocon also.
Okay, the market, by the way, is now a bit comatose from 3 p.m. Today is complete reversal from Tuesday when the market had that sharp 3 p.m. move as well. But some individual names do stand out. I mean, just look at GMR Infra. That's now your top F&O gain is 7% higher on that. Ashok Leyland is just phenomenal. The move in Ashok Leyland is really, just running out of adjectives here. 5.5% higher, 6% almost on the stock. And from the recent lows, the stock's doubled. SRF, Astral, Tata Consumer, there's so many stocks doing well right now. So looking quite good over there. Indian Hotels is the other one where you're seeing some bit of moves. Tata Communications, so many individual names doing well. Amrish, GMR seems to be making a bit of a comeback. Any views here?
In fact, that was my favorite stock about close to 3-4 years back in those low teens. It was quoting at, I think, about 14-15 levels, and that's played out quite well. And the way I see going ahead, I think more than airports, I think the railway stations will be a very big sort of an opportunity for someone like GMR. And I think that's going to open up decently soon. So again, I'll not possibly recommend buying GMR at the current levels, but clearly on a sort of a correction to levels of about 30-31 levels, I think it becomes a good buy.
GMR Infra has a board meeting tomorrow where they will consider a fundraise of up to 6,000 crore rupees, which could be via a combination of QIP or FCCB. So the stock is active ahead of that fundraise. Board meeting, which is scheduled tomorrow. They've got some planned capex in Goa Airport, Delhi, Hyderabad, and the debt on the books is nearly 24,000 crore rupees. So this equity fundraise could be quite crucial. Get into a break on that note. Amrish, do stay on. We've got a lot more by way of market chatter coming up. Welcome back. SpiceJet is down 3.5% today. Came out with numbers for Q4 as well as Q1. Sonia is standing by at the big wall with a complete analysis on the stock. Sonia.
Well, troubled aviation company SpiceJet tumbled in trade today. The stock, in fact, is down almost 40% in the last 1 year after the company reported steep losses in its financial statements. Now, after much delay, SpiceJet reported both Q4 FY22 and Q1 FY23 earnings, and it's not looking good. SpiceJet reported a loss of 1,721 crores in FY22, much higher than the sub-1,000 crore loss that they reported in the previous year. Now, even in the first quarter of the fiscal FY23, SpiceJet's losses escalated to almost 784 crores versus a loss of 485 crores in the previous quarter, that is in Q4 of FY22. One of the big reasons for the large losses is the steep rise in ATF prices. Now, ATF prices in Q1 went up 105% year-on-year and 40% quarter-on-quarter in Q1 itself. However, SpiceJet has seen escalating losses for the last few years without any respite. So let's map the last 6 financial years for the company. The losses have actually risen from 316 crores in August to about, in FY22, the losses were 1,720 crores. Now, there are several problems that are plaguing SpiceJet. The company in August of 2022 delayed salaries for the second straight month. 2 more aircrafts, the Boeing 737s, have been deregistered by the DGCA, and the Chief Financial Officer Sanjeev Taneja resigned on 31st of August. Also, there are deep cracks appearing in the financial health of the company. If you look at it, the auditor in the report of Q1 says that these results cast significant doubts about the company's ability to continue as a going concern. The current liabilities exceed the current assets of SpiceJet by 6,400 crores, and this brings us to the inability of the company to raise funds over the last few years, which has also been a big uncertainty. SpiceJet, though, has said that it is shortly engaging with investment bankers for a potential raise of up to US $200 million.
All right. Thanks very much, Sonia, for that. That's SpiceJet for you in focus very much at this point in time. Amrish Baliga, of course, is still with us. Mitesh also is with us. There's about 6 minutes to go for close. Amrish, any thoughts on the problems SpiceJet is facing and the entire sector, really?
No, I mean, the way I see it is there are red flags all across SpiceJet. Competition has increased now. Air India is getting aggressive. Akasa is expanding. We could have Jet Airways back possibly in the next couple of months. They've already been delayed. And whenever you have financial issues, especially for an airline, customer service gets affected. Schedules get affected quite a lot. So right now, nothing is going right for SpiceJet. And lately, the CFO also resigned. So, like I said, all red flags around. So I think it's still a good time for people to exit because we have seen, what's happened to airlines in the past. We have seen Kingfisher also. So better to exit at these levels. Still, you're getting some value.
Okay, Amrish, thanks a lot for joining us. Good talking to you as always. Before we wrap up for the day, let's hear out some more opinion that we got this time with Ajay Srivastav of Dimensions Corporate Finance.
We just moved out of it last week, Sonia. Completely, we have moved out of autos at this point of time. And I think the reason is very simple, that I think they're factoring in a lot more than what is possible in the market. I don't think we are, in our view, it may be wrong totally, market can surprise us. The point of interest rate coming in and kicking in and taking the demand out has still not factored in. It takes 4 or 5 months to come into the place. We have found better places to invest our money compared to incremental return that may or may not come in the auto space. IT has a particular problem among all the sectors. It has the highest proportionate ownership of FPIs, has the lowest proportionate ownership of the domestic investors, and certainly very low in terms of HNIs and individuals. And therefore, they are quite susceptible to what happened in the global market. That's the one particular sector in India where the demand supply of stock comes into play very fast, because the moment the price goes up, the FPIs start to sell. And India, whether we like it, we like Infosys, we like TCS, the fact is, retail ownership is low, institutional ownership is low, FPIs are over 40%. So what's happening in the US therefore translates more to the share price than perhaps the rest of the Indian economy. This is one sector totally exposed both on the demand side as well as on the investment side. Hotels will see a kind of profit profitability which they have never seen before in their lives. You just have to go through Booking.com or Expedia to know what's happening in this segment. And I think the top 2-3 chains will make superlative profits. What they made just now is nothing compared to what's coming in the October to December and Jan to March season. So it's a very clear buy and hold segment. Any correction means you need to get into a hotel business. God has really been kind to that sector, and I think they'll make more money. So there's no question, you got to be there.
Okay, that was Ajay Srivastav. Let's now start wrapping up the market action for the day. Very curious day. The market had a gap down, then a strong recovery, and then second decline. And it's actually closing right between the highs and lows of the day. 17,555 is where we are on the Nifty. The Bank Nifty as well, right between. Bank Nifty is more closer to the highs of the day than lows of the day, but even then, there was quite a bit of volatility. The mid-cap index is ending in the green, of course. In terms of individual names, let's start with the losers first. Reliance was the biggest pressure point for the market. In fact, a lot of stocks which have exposure to global earnings, whether it's Infosys, whether it's TCS as well, which was down quite a bit. So, in fact, the entire IT sector put pressure on the market. Tech Mahindra as well, Tata's other commodity stocks also, Hindalco, Tata Steel, Coal India were all lower, Shree Cement as well, Sun Pharma was down, HDFC and ICICI Bank from the heavyweights put quite a bit of pressure on the market. In terms of stocks gaining ground, consumption has really been the go-to pocket. So Tata Consumer up 4%, Eicher Motors, Hero MotoCorp, both of these stocks did well, Asian Paints, Bajaj Finserv, all these stocks were higher. But Prashant, the broader market, a bit of an outperformance.
Oh yeah, broader market outperformed really. So market breadth was 1:1 in favor of, not 1:1, separated by what, 50-60 stocks. So let's make that differentiation, but not by much. Let's just take a look at what did the best on volumes by close. Zomato was up 8% at 63. TTML is having a fabulous last couple of days, 17% higher. Reliance Infra, Reliance Power, 20%, 20% respectively. Basically limit up. Tejas Networks was up 9%, 670 on Tejas Networks. APL Apollo 9% higher, 1033. Paradeep, was down, was up 11-12%. GMR Infra we discussed 7% higher. Religare was up 17%, 153. That's a big one. That of course also houses the insurance subsidiary Care. There is Latent View, which was up 6%. Aether was up 6%. D-Link India about 8% higher, and so on and so forth. But this is some of the big volume-led gainers in the broader market. Rima.
Well, a couple of these auto sales reactions also played out today. So you had Ashok Leyland, strong numbers for the month of August, plus that big UAE order. So Ashok Leyland was a big mover. TVS Motors ended with gains. Escorts too was higher by close to about 1.5%. Apart from that, you had weakness coming through in Biocon on the back of the US FDA observations at 2 of its facilities. Z Entertainment was weighed down by the CCI overhang. Well, that wraps up the markets in terms of numbers and big movers. We end with cuts of more than 1% on the benchmark indices, but we are clearly off from the early morning lows, but we were weighed down by the weakness that we had across the global markets and the Q1 GDP print. With that, it's a wrap on Closing Bell, but don't go anywhere, as on the other side, we'll shift our attention to the Open Credit Enablement Network for OCEN on our Thursday special Big Deal.